Two ETFs built on the same explosive stock, super microcomputer, but running completely different engines to spit out those headline yields. SMCY from YieldMax and SMYY from GraniteShares both pay every single week, both sit in the derivative income space, and both have seen their net asset values get absolutely hammered since they launched. One uses a synthetic covered call machine collateralized by Treasurys to harvest premium. The other layers daily 2x leverage on top of put writing. The yields look insane on paper, but the real story is what each strategy actually does to your money when super micro moves, when volatility changes, and when the option premiums start to shrink. If you've ever wondered whether chasing 200% yields on a single volatile name is clever or just expensive entertainment, this head-to-head opens the hood on both. The YieldMax SMCY Option Income Strategy ETF, ticker SMCY, launched on September 11, 2024. It does not simply buy super microcomputer shares and sell calls the old-fashioned way. Instead, it runs a synthetic covered call. The fund parks the vast majority of its assets in short-term United States Treasury bills, holds a cash offset, and keeps a slice in the First American Government Obligations Fund. That stack of T-bills and cash serves as collateral. Against it, the fund writes 2 call options on SMCY. When those calls are sold, the buyer pays the fund a premium today. That premium becomes the main source of the weekly distribution. In exchange, if super micro rallies hard above the strike price, the upside above that level belongs to the call buyer, not to SMCY investors. The fund keeps the premium either way, but it has essentially agreed to sell the economic exposure at a fixed level. It is like owning the stock with a pre-signed contract that hands over any big rally to someone else. The GraniteShares Yield Boost SMCY ETF, ticker SMYY, launched on September 30, 2025. It is actively managed to deliver daily 2x the price moves of super microcomputer while also pulling in income. Its holdings are a blend of US dollars, United States Treasury bills, and cash equivalents. The 2x leverage is achieved through derivatives, not by borrowing and buying twice as many shares. On top of that leveraged exposure, the fund writes 5 put options on SMCY for additional premium. Selling those puts brings in cash now but creates an obligation to buy the stock if it drops below the strike. So SMYY gives you amplified daily moves in both directions, plus an extra income layer that only works if the stock stays above the put strikes. The two strategies could not be more different in how they interact with the same underlying name. One caps rallies to collect steady call premium. The other amplifies every wiggle and adds put-selling risk on the downside. Both funds sit in the same broad derivative income category and both target super microcomputer, yet one investor is essentially renting out upside while the other is renting out downside protection and then doubling the ride. That difference shows up in every other dimension we are about to examine. This video is for research and educational purposes only. It is not financial advice, investment advice, tax advice, or legal advice. It is not a recommendation to buy, sell, or hold either fund or any other security. Exchange-traded funds can and do lose value, sometimes substantially. Past performance and current yields do not predict future results. The numbers we discuss come from publicly available fund data at the time of recording. Always read the latest prospectus, statement of additional information, and fact sheets directly from the issuers. Consult a qualified financial professional who understands your personal situation before making any investment decision. The headline distribution yields are 202% for SMCY and 190% for SMYY. Both paid weekly. Those eye-popping figures come directly from the option premiums each fund collects, not from dividends inside super microcomputer itself. SMCY harvests premium by writing its 2 calls against the Treasury collateral stack. SMYY collects premium from its 5 written puts while the leveraged derivatives handle the 2x exposure. Because the income is option-driven, the actual cash that lands in your account each week can swing dramatically depending on implied volatility and where super micro is trading relative to the strikes. Look at how the cash flow has already changed. SMCY's first 4 distributions averaged 291 cents per share. Its latest 4 averaged just 7 cents per share. SMYY moved from a 68-cent average down to 13 cents. That compression happens because option premiums shrink when volatility falls or when the stock price moves in ways that make the strikes less attractive to buyers. The 202% and 190% numbers you see advertised are snapshots, not guarantees. A fund that was mailing out nearly $3 a week early on can quickly drop to pocket change once the options market stops paying up. For someone counting on that income stream to cover bills, the difference between hundreds of cents and single digits is not a rounding error. It is the difference between a workable plan and a sudden hole in the budget. Both strategies are there for selling volatility rather than owning a growing business, and volatility is a fickle thing to sell week after week. The net asset value paths tell the other half of the story. SMCY launched with a reference price of $51.82. Its latest net asset value sits at $4.82. That is a 91% decline in the actual share price of the ETF since inception. SMYY started at a reference price of $25.98 and now trades at $6.88, a 74% drop. These are not small mark-to-market wiggles. They are structural reductions in the value of the fund itself. The erosion occurs because the weekly payouts frequently include return of capital when option premiums alone cannot cover the distribution target. The synthetic covered call in SMCY means that when super micro rallies, the calls the fund wrote get exercised and the upside never reaches the net asset value. In SMYY, the daily 2x leverage magnifies every down day, and the put writing obligations can force the fund to take on shares at unfavorable prices. Either way, the net asset value is being harvested to keep the weekly checks flowing. An everyday investor who bought at launch and simply watched the share price would see the investment value cut by 3/4 or more even before taxes or opportunity cost. The net asset value is not a side detail. It is the part of your capital that remains inside the machine after the income has been peeled off. If you add every cash distribution received to the ending net asset value and calculate the simple distribution inclusive return, SMCY shows negative 30% while SMYY shows negative 23%. Those figures already include the $31.54 per share paid out by SMCY and the $13.09 per share paid by SMYY. In other words, even if you treat every weekly payout as part of your total wealth, you are still behind the reference price you started with. This number matters because it reveals whether the options strategy actually created value or simply transferred capital from the net asset value line to the distribution line. In both cases, the machine did not generate enough net new wealth to offset the price decay. An investor who needed the income might still prefer the cash flow, but anyone hoping the high yield would also protect or grow principal has seen the combined picture come up short. The gap between the two funds here is narrower than the headline yields suggest, which tells you the extra leverage and put writing in SMYY did not produce a meaningfully better all-in result once the full cycle of gains, losses, and payouts is counted. The maximum drawdowns underline how punishing the ride has been. SMCY experienced a 92% peak-to-trough decline. SMYY's worst drawdown reached 74%. Those are not theoretical risks. They are the actual worst losses recorded so far, and they happened while the funds were already mailing out weekly checks. The payout trend compounds the problem. When the average distribution collapses from 291 cents to 7 cents inside one fund and from 68 cents to 13 cents inside the other, the income you were counting on becomes unreliable exactly when the share price is also under pressure. SMCY's call writing approach means investors sit out big recoveries once the strikes are breached, so the fund can lag on the way back up. SMYY's daily 2x leverage means every down move in super micro is doubled before the put premiums even enter the picture, and the obligation to potentially buy shares on weakness adds another layer of exposure. Neither structure offers a free lunch. One exchanges upside for premium while accepting severe price decay. The other amplifies moves in both directions and layers on additional put risk. For an investor whose portfolio cannot absorb a 70 or 90% drop without panic selling, these are not minor footnotes. They are the central feature of the product. SMCY and SMYY are two distinct tools built on the same volatile name. One systematically caps participation in rallies to harvest call premiums against Treasury collateral. The other delivers daily 2x exposure while collecting put premiums and accepting the associated downside obligations. The first may appeal to someone who wants a high weekly cash flow and is willing to miss large upside moves and watch the net asset value shrink. The second may suit an investor who believes super micro will deliver strong upward moves and wants that magnified daily while still receiving some option income. The choice hinges on your specific goals, time horizon, tolerance for drawdowns, and views on future volatility and price direction. Different investors will reach different conclusions about which set of trade-offs is acceptable. This remains research and education only. It is not a recommendation to purchase, sell, or hold either fund. Market conditions, option premiums, and super micro's price path can change quickly. Verify every figure against the most recent fund documents and speak with a qualified professional who can assess how these strategies fit inside your overall financial plan. 2 quick things before you go. If this head-to-head helped you cut through the hype, hit the like button and subscribe. It is what keeps these autopsies coming. And tell us in the comments, which of these two would you pick and what matchup should we run next? We read everyone. Thanks for watching.